The income statement. The income statement records how revenues are converted into net income. The main factor in how much revenue is left is by subtracting expenses to derive the net income. The income statement records the profit or loss for a period of time for the corporation. The balance sheet only shows one moment in time. The income statement formula is revenues minus expenses equals income. Earnings per share is defined as the amount of profits per outstanding common share. It is used as an indicator of how profitable the company is. The EPS ratio is calculated as net income minus preferred dividends divided by average outstanding shares. Non-cash items. An important concept to know about the income statement is that it records non-cash items. These are items such as depreciation, amortization, or depletion. To explain this concept, think of cash inflows and outflows. If you were to buy a machine for $10,000 that has a life of 5 years, it would not be recorded as $10,000 expense on the income statement, like it would on the statement of cash flows. Instead, the income statement would record a $2,000 expense each year for 5 years. The important thing to remember here is that the cash outflow occurred when the machine was purchased, which was recorded on the statement of cash flows. On the income statement, the only thing that is recorded is a $2,000 yearly expense. There is no $2,000 cash outflow per year because it is merely an accounting number. The reason we account this way is because under GAAP rules, we follow the matching rule, which states that revenues should be matched with the expenses. We do this because we want to see how much expenses were incurred to generate the revenue. The expenses of the machine would be incurred over a period of time, as well as the income generated from the machine. Understanding this concept is important for valuing the market value of a stock. Product and period costs. There are two forms of costs, either product costs or period cost. Product costs are recorded as cost of goods sold and include such things as raw material expense, factory overhead, and direct labor costs. Period costs are fixed to a period of time, such as administrative salary expense and property taxes. Period costs are fixed for the short term, but may be variable in the long run. GAAP, generally accepted accounting principles, are important to the income statement because the income statement and other financial statements must present comparable financial information to investors. This means that certain regulations and guidelines must be followed. There are two important GAAP concepts that are relevant to the income statement, which are accrual accounting and the matching principle. Accrual accounting. To record revenues, we record the transaction when the services is earned, not when the cash is received. For example, a piano lesson service business sells piano lessons to a client for $100. The client agrees to pay 1 week after the services have been delivered. According to accrual accounting, we will record $100 revenue when the piano lessons are finished, and not when the cash is received 1 week later. Matching principle. This principle realizes the expense associated with a given source of revenue when the revenue is generated and not when the expenses are paid. Taking the previous example, the $10 an hour teacher's pay expense would be recorded once the lessons have been completed, and not when the cash is paid to the teacher. These two principles are the reason the income statement does not match the cash inflows and outflows as we would see with the statement of cash flow. For more information, please visit www.financecompendium.com. Thank you.